Financial gurus like Dave Ramsey say indexed universal life insurance is too expensive and a ripoff. Is he right? That's what we'll be talking about in today's video. Hey folks, I'm Dave McKnight, best-selling author of The Power of Zero. Financial gurus like Dave Ramsey and others have repeatedly made the claim that indexed universal life insurance is too expensive, a scam, a ripoff, and that if you own one, you should cash it in regardless of how big the surrender charge. Susie Orman has even said that if an advisor ever brings it up, you are to never work with them again. Now, clearly, these celebrity gurus have reputations to protect and wouldn't make such sweeping claims about IUL if they weren't true. They can back all their claims up with math, or they wouldn't be making them, right? Right? Well, today we're going to put those claims to the test. When someone claims that the IUL's fees are high, the first question you should ask is, compared to what? In today's video, we're going to compare those fees against the fees you would likely pay in a traditional tax-free investment if you were to follow Dave Ramsey's advice. And what is Dave Ramsey's advice? If you go to his webpage, you'll immediately be steered towards his network of SmartVestor pros. These are Dave Ramsey approved independent advisors who must conform to a code of conduct. Now, I perused those guidelines to see if there were any limits on the fees those advisors are allowed to charge. Here's what I found. There are no limits on the fees a SmartVestor Pro can charge. So for today's comparison, I will simply be using the fee most commonly charged by independent financial advisors, and that's 1.5%. That consists of the 1% asset fee charged by the advisor and an additional fund expense of 0.5%. So the real question becomes, when we compare the fees of an IUL against those of a typical Dave Ramsey referred SmartVestor Pro, which one comes out on top? Well, the first question we have to ask is, how do you quantify the IUL's fees? Do you just look at the fees in the first year, the first 10 years, the first 20 years? Well, this much we know. The IUL contract is a bit like getting married. It only really works if you keep it until death do you part. And if that's the case, then we shouldn't fixate on the expenses in the first 5 years or even the first 10 years of the program. We must look at the IUL's expenses over your entire lifetime. In most cases, that means over the arc of a 30 to 50 year time period. In today's example, we're going to look at a 40-year-old named Mike Jones. Mike is in excellent health, is contributing $20,000 per year to an IUL, and wants to maximize the growth of his cash value over his lifetime. So the first thing we are going to do is acknowledge that the expenses in the IUL's first few years are going to be dramatically higher than the fees of the SmartVestor Pro's comparison account. Let's take a look. In the first year, Mike contributes $20,000 to his IUL. Now, because the IUL is a very transparent product, we can go to the illustration and determine exactly what fees Mike will be paying that first year. According to the illustration, he'll be paying $3,502. That's 17.5% of his first year's premium. Oh no, Dave Ramsey was right. Had Mike Jones used a SmartVestor Pro, he would have only paid $300 that first year. This isn't looking good. Now, granted, Mike does have a total death benefit at the end of the first year of $351,757, but if you wanted a death benefit, you could have bought an inexpensive term insurance policy for much less than $3,502, right? Okay, let's keep going here. By the end of the 10th year, the IUL's expenses have gone down a bit. Remember, the IUL is front-end loaded, so this should be expected. The expenses we pay in the 10th year are $2,702. Still not awesome. But let's compare that to the SmartVestor Pro's comparison account that now has a balance of $264,151. At 1.5% of the total balance, those fees are $3,962. Wait, what? They're already more expensive than the IUL? All of a sudden, the SmartVestor Pro isn't sounding all that great. But don't fret. Dave and Susie are both thoughtful people, so surely their math will work out in the end. Let's fast forward to the 25th year. In the 25th year, the IUL's expenses are $2,568. The balance is $1,088,226, and the overall death benefit is $1,422,302. When we look at the SmartVestor Pro's balance and the comparison account, we see that it's only $1,002,417. At 1.5%, his fees that year were $15,036. Uh-oh, now the tables seem to have turned and the IUL is surging ahead. Let's fast forward to year 40 when Mike Jones turns 80. His cash value is now $2,789,365 and his death benefit is $2,928,834. The expenses he paid that year, however, were only $2,964. Let's compare that with the SmartVestor Pro. Because of that sky-high 1.5% advisor fee, his balance at that point is only $2,084,250, which means he paid $31,263 of fees that year. $2,964 versus $31,263. So I think I'm starting to identify a trend here. The expenses in the IUL are higher as a percentage of your balance in the early years, but they're much lower as a dollar amount in the later years. The longer you keep it, the better it gets. On the other hand, the SmartVestor Pro's fees are lower as a percentage of your balance in the early years, but much higher as a dollar amount in the later years. In fact, the longer you keep it, the worse it gets. When you look at the internal rate of return of the IUL in the 40th year, you'll see that it's 6%. That means that the average annual expenses over the life of the policy to that point are actually 0.6%. And the average annual expense of the SmartVestor Pro comparison account in the 40th year, still 1.5%. Now, you may be thinking, hey, I think I can do better than a 6.6% gross rate of return with my SmartVestor Pro advisor. After all, Dave Ramsey says I should be getting at least 10% in my investment portfolio over time. Well, this is the other big fallacy that Dave Ramsey and Susie Orman perpetuate. No one's really suggesting that the IUL take the place of the stock market portion of your portfolio. At least I'm not. What I am suggesting is that you make your IUL the bond portion of your overall investment. Reach into your current investment portfolio, take out your bonds, replace them with your IUL. If you do so, you're going to increase your return, lower your risk, lower the standard deviation of the entire portfolio, and experience a better outcome over time. Plus, you'll be getting a death benefit that doubles as long-term care along the way. Here's the bottom line, folks. I'm not trying to make the case that you put all your money into the IUL. In fact, I've long suggested that at best, the IUL is a good complement to other tax-free investments such as your Roth IRA and your Roth 401k. What I am saying, however, is that when financial gurus claim that the IUL has high punitive fees, we must respond with one simple question: compared to what? Because if you compare the IUL's fees to the fees of the Dave Ramsey referred SmartVestor Pro, you'll find that the IUL is much, much more cost effective over time. And that's the dirty little secret that Dave Ramsey doesn't want you to know. If you want to see how the IUL fits into a comprehensive, balanced approach to tax-free retirement, head on over to davemcknight.com and click on the Work with David button. I'm happy to lend a hand. Now, if you have any comments or questions, feel free to drop them into the comment section below. I'll respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.